Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity of these markets using the best practices of technical analysis. Charts can tell us so much about investor behavior, about investor psychology, investor sentiment. All of that can be determined or can be inferred for sure from the evidence that the markets provide back to us, the evidence in the form of price and breadth and sentiment. We'll do our best today, as we usually do, to try to make sense of all of those different inputs and collectively illustrate what we see the market overall doing. A choppy day today, and this is a similar feel to what we saw yesterday. A lot of up and down swings during the course of the trading day. In the end, we really didn't net out to a big move. The S&P, the NASDAQ up less than 0.5%. At the end of the day, it's all about the big picture. And I think the challenge for this market right now is we have accelerated up to key resistance. That happened last week. We've now pulled back from that key resistance. And the big question mark is what's next? With a lot of my guests, we've tried to determine where the path of least resistance may be, what the potential outcomes may be as well. Let's see what we can learn from some of the individual charts we look at during the course of today's show. Great guest today, by the way, David Auerbach. He's been on the show before, always shares some real estate ideas, which I think for a lot of individual investors is an area of the market where they're less familiar. And that's why I think it can be a really valuable conversation. Tomorrow on the 25th, on Thursday, we have Tony Dwyer from Canaccord Genuity in New York. Next Tuesday, we have Joe Rabel from Rabel Stock Research. And then on Wednesday, the 31st, Mish Schneider, host of Mish's Market Minute, and from Market Gauge, here on StockCharts TV. Also, we have a little event coming up, and by little, I mean huge, coming up at the beginning of October 7th and 8th, ChartCon. ChartCon is a StockCharts event. We will feature many of our hosts on StockCharts TV, a number of our guests that have come through, and really spend 2 days taking a step back and thinking about what the fourth quarter and beyond will most likely bring for stocks and ETFs, as well as other asset classes as well. We have a fantastic group of commentators, all that will be coming to you live from our Redmond studio in Redmond, Washington today. I just want to highlight one of the sessions called a Bulls versus Bears debate. We're going to take 4 key macro charts, and 2 of our commentators, one each, will be a bull and one will have the bear side. They will each argue their case. You can listen to the bullish and bearish arguments, vote on which you think is a better take on that particular asset. That particular chart at that time will be a really good way to stretch your thinking and think about some alternative scenarios. What if this goes higher? What if this goes lower? What would that mean for my portfolio, for risk? For that event, you should sign up today at stockcharts.com/chartcon. And if you're a member or if you're on a free trial, you get a deeply discounted rate. So if you're a StockCharts member, thank you so much. And please join us for that event. If you're not, this is a really good time to take a free trial of the StockCharts platform. Let's continue on today's show with our market recap. Let's look at what's happened again. As I described, sort of a choppy day with the S&P finishing up about 0.3%. Let's look at the rest of the markets and see what we can see. S&P finishing the day around 4140. Again, it's up about 0.3% from yesterday's close. The NASDAQ up a little bit more, 0.4% to 12,430, a little bit above there. Mid caps and small caps all in the positive. The VIX actually down a little bit, had been sort of pushing higher through the course of this week, pulling back a little bit, but still well above 20, which is sort of the lowest level we've been for most of 2022. So overall, volatility has been coming higher in the last week or so, pulling back a little bit today. Interesting to see the markets move higher today. Interest rates actually moving higher as well. 10-year yield pushing above 310. Long bond yield, the 30-year yield above 332. It's where it ended the day. The dollar index really flat from yesterday, and here we're using the UUP, which is a bullish dollar ETF. I highlighted the chart of the commodity ETF DBC. I think on the show yesterday, it was one of our 3 and 3 stocks, up another 1% today, just below 27. And, when you think about inflation, there are different ways that inflation can be measured. There's different ways inflation can be reflected in different parts of the market. I think you're seeing commodity prices pushed to the upside is certainly a part of that. Oil prices up today in the energy sector, as I mentioned in the introduction, the strongest performer of the 11. Cryptocurrencies overall mixed using the 10 most liquid coins that we track, but Bitcoin and Ether both up less than 1%. So for cryptos, it's a pretty mild day in either direction, but overall trying to regain some of the drawdown that we've seen recently. Choppy charts all around for a lot of cryptocurrencies, but particularly the big ones, Bitcoin and Ethereum. Let's look at a chart of the S&P 500, talk about what sort of things have played out today. What did we learn? To be honest with you, in terms of the long-term perspective, I'm not sure if we learned a lot, because here's how I would describe this market environment. There's no doubt that the first 6 months of 2022 were painful for risk assets by any stretch. And there's also no denying that the last 2 months have been very strong for risk assets, particularly growth areas of the market like technology, communication services, those types of sectors, the FANG sectors really, which have pushed the market higher as rates and as the dollar have pulled back a little bit. Now we're sort of in that question mark reset kind of phase, sort of a recalibration. Now that the major averages have rallied so much off of the lows, still down for the year, but down a lot less than they were 2 months ago. We hit the 200-day moving average. The S&P hit the 200-day. A lot of key stocks like Microsoft and others hit the 200-day moving average, and all now rotating down a little bit. Here's where I see the S&P, right? We're between kind of two key levels here, right? 4,100 is this red shaded area. This is the level we talked about really starting last February of this year, which is when we bounced off of the low there. We made a higher low in March and then ended up attempting to get to a new swing high around 4,600. That was that last big bear market rally before the rotation lower. We had another nice bounce there in May, which stalled out just above that same level, just above that 4,100 level. We sort of rallied up to there, and then powering through 4,100, I think, was part of that indication that this was something different. Instead of just being a kind of standard bear market rally for 2022, this is a little something more sustained, a little something more stronger in terms of momentum characteristics and breadth characteristics than we've seen in previous bear market rallies. But here's the thing, we've now hit the 200-day moving average and pulled back to that 4,100 level. So one of these things is probably going to happen pretty soon. Option one, we get below 4,100 and really below that 38.2% retracement level, which is around 40.88. The other option is we power back above the 200-day moving average and get above 43.70, which would be the 61.8% level. One of those things is most likely to happen in the next couple of weeks, I would argue. Whichever way the market breaks, right? If it gets above 43.70 or below 40.90, we'll call it, I would argue whichever way we break, that is probably the direction of momentum from here, because we had the sell-off, we now had the rally, we're now sort of backing and filling within this range. Which way do we break? Now, I would tell you the challenge I have with going higher is the fact that we are now in the seasonally weakest part of the year. We're really getting into that. August into September tends to be pretty weak for the markets, but especially for growth stocks. We talked about that a little more on yesterday's show. So if you missed it, make sure you go back and observe that episode where we dug into that in a little more detail. My guest yesterday, Craig Johnson, pretty optimistic and pretty bullish in terms of his overall outlook. He was talking about a year-end target for the S&P essentially at the previous highs around 47.70. That would be quite a nice rally from where we're at right now, and that would certainly involve a break above that level of resistance. So, if you asked me to pick which way is more likely, I'd probably say moving lower. And that was actually one of the surveys we did on our social media accounts last couple of days, was which way do you see first, a 10% move down or up? And I think 70% of you said lower rather than higher, and I would tend to agree. Having said that, break above 43.70 would very much change the character of this market, really reinforce the upside momentum, not just getting us to the 200-day moving average, but powering us well above those levels. Just to finish off our market recap, looking quickly at sectors: energy, number one; real estate, number two; followed by communication services. On the downside, technology, the worst performer of the 11, still flat for the day. I mean, just a rounding error above the zero level. Same to be said for healthcare and materials. Materials is an interesting one because we've seen some materials names pop up into the new swing highs list. Mosaic comes to mind as a stock that had a nice day today, but it's after really continuing a move that we've had for quite some time. And when I'm looking at a chart like Mosaic, it's not just the fact that we had a good day today, it's the fact that that comes after a nice run, sort of a pause around the $55 level, and then the last couple of days have been really re-emerging as in a new position of strength. Stocks usually become overbought only in a bull market phase. And if you look at what's happened over the last year or so, There's a lot of Mosaic becoming overbought and then pulling back and testing key moving average support. Is this the beginning of the next leg higher for some of these material stocks that I think a lot of people have been writing off as they've sort of been stagnating as other areas of the market have been improving? Folks, let's take a quick commercial break. We'll be back with today's guest, David Auerbach. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close. A couple announcements before I bring on today's guest, David Auerbach. First off, we welcome your questions. We had a great mailbag segment yesterday, some really interesting questions about industry indexes, some other indicators as well. We'll do another mailbag segment on Friday's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we are on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. I want to welcome on today's guest, David Auerbach. David's a managing director at Armada ETF Advisors. David, it's a pleasure to bring you back on. I always really appreciate the opportunity to think about real estate. It's an area of the market I think a lot of people are probably underexposed and underfamiliar. And thanks for broadening our understanding a little bit better. Welcome back.
Dave, always great to be here. I look forward to seeing you in a couple of weeks so we can go grab some red pepper pizza in person. And I love, you know me, I love talking about the world of REITs and real estate. So I'm really happy to get into it with you today.
So REITs, as you probably saw, one of the better sectors today, one of the leading sectors in the S&P. We're going to start looking at an ETF I know you're familiar with, House, HAUS. Start us here. Talk to us about the overall real estate environment.
First, I want to note that I'm 4 for 4 on appearances with you. On the 4 times I've been on, the real estate market's been doing well that day. So let's just keep that in mind. You know, we launched the Home Appreciation US REIT on March 1st of this year. Why? What does every single investor have in common? Well, the answer is the roof that's over our head where we go to sleep every single night. House is comprised of 25 pure play residential REITs comprised of apartments, single family rentals, manufactured housing, and senior housing. If you look, you talk about the headlines with the market sell-offs we've been seeing over the past few months. And if you take a look at the chart that you're showing here right now, because of that inflation hedge, that is that necessity-based demand for residential real estate, our performance has been holding up relatively well. And the reason being, with rising interest rates and inflation, the residential REIT guys, the rental players, they don't really care that interest rates are going up or inflation is going up necessarily. Because look, we both know next week the landlord's going to knock on the door saying it's the first of the month, the rent's due. Where's the rent payment? And so as a result, we're going to highlight a couple of the constituents here inside the ETF. And I just want to emphasize, the strong results that these companies are reporting. What do you want from a Wall Street company? Well, you want to see a company announce growing revenues and net income. You want to see them raising guidance and raising their dividends. Well, in the face of this down tape that we've been seeing right now, that's what our constituents have been doing. They've been putting up solid results. So if we can look at our first constituent here, next point is a smaller residential apartment REIT based here in Dallas. I happened to just visit with the management team today. Listen to some of the markets that they're invested in: Nashville, Atlanta, Raleigh, Charlotte, Orlando, Tampa, Dallas, Phoenix. These are the places where everybody's been migrating during COVID. One other interesting, unique angle about this company, unlike any of the other residential REITs, they have a really good knack of doing what I call tenant renovation program. I want to read some of these numbers to you. They did their IPO in 2015. Since they've done their IPO, they've completed over 6,800 full apartment unit upgrades, 4,700 replacements of kitchen appliances, and 9,600 technology packages, smart doorbells, smart thermostats. But listen to this. The ROI on those technology and various upgrades, so we'll do full upgrade, laundry upgrade, kitchen upgrade, and technology. ROI, 21.8%, 69.7%, and 33.5%. Meaning If they go in and upgrade the property, they're able to basically recognize almost a 40 to 50% on average ROI just on that one unit of renovation.
Impressive numbers, to be honest with you, on that one. On next point, your other one you wanted to show us is Center Space, ticker CSR.
This is another unique residential REIT. Now, they're based out of the Midwest. They're focused on markets like Minneapolis, Grand Forks, North Dakota, Bismarck, Rapid City, Billings, Montana, Omaha, Rochester. Much different portfolio mix than Next Point. But the key here is that this is considered workforce housing. This is like the blue collar Midwest where a lot of folks are located. Well, look, these guys are reporting double-digit net operating income increase year over year. They're 95% occupied. They've raised their earnings almost 15% year over year. If we're concerned about job slowdowns and economy cratering and all these stuff, this workforce housing type of company would not be putting up the strong results that they're putting up. The key here, the takeaway is we don't know where the housing market is going. Yeah, we know prices are going down. We know mortgage rates are going up. Case in point, the house that I bought, my first house in 2006, we bought it for $150,000. That same house, according to Zillow today, is worth $450,000. Is it a $450,000 house? I don't think so. But in the same breath, I would not be able to afford that on my 2006 salary. And thus, I would have had to have rent for much longer into the future. So at the end of the day, we know that there's this huge consistent supply of demand for these residential units. And thus, why you're still see a long runway of growth for apartments, single family rentals, manufactured housing, and senior housing.
It's such a great description of how these companies or how these REITs can be a compelling option here. We only have about a minute left, David, but I'd love to just think about, we've talked a lot recently on the show about seasonality and cyclicality, right? And we're entering a part of the year which tends to be relatively weak for stocks going to September. Do you see similar kind of cyclical or seasonal trends with real estate? How does that go into your process going forward?
Man, you get me so excited, Dave, because I know we're focused on the world of residential. I'm a little biased here. Right now, what's the quote unquote the slowest time of the year is prime residential REIT leasing season. These are the students that are going into fall, on college campuses as an example. But the summer going into the fall is prime residential REIT leasing season. These are the times that basically companies make or break their year going into next year as well. And so as a result, we may see some more of these trends. We may be return to office. There's companies that have return to office coming in after Labor Day, and there's companies that are not. We're seeing a little bit of resurgence in retail. And in the same breath, we're seeing some properties that are still taking a hit. But for us in the world of residential, no, we still see this long runway to growth. And even if these guys moderate from a 16% growth to an 8% growth, over the course of the next 6 to 9 months, well, you're still putting up almost double-digit growth, regardless of the economic conditions.
It's a great take, David. Listen, as always, I feel like in a couple minutes, you do such a great job of just sort of spreading some expertise and helping us understand the REIT space a little bit better. Stay safe there down south. We'll look forward to seeing you up here soon, and we'll talk to you again, all right?
Thanks, Dave. Thanks so much for having me. I'll see you soon.
That's David Auerbach. David's a managing director, Armada ETF Advisors, creator of the ETF House, HAUS, which we showed earlier. And congrats to David and the team on their successes early on and for ongoing success. I've often talked, in my experience in the institutional investment world, real estate is one of those areas of the market that most portfolio managers would think about an allocation to. And when it was broken out as its own S&P sector, it sort of became the 11th S&P sector, really well-deserved because it really is different than the rest of the financial space, really deserves its own sort of area of the market, an area of consideration. So great take there from David Auerbach from Armada ETF Advisors. We're going to continue on the ETF run here today with our next segment, ETFs Engage. What we like to do occasionally is take a step back and look at a particular group of ETFs and just talk a little bit more about the structure. We throw around a lot of tickers on this show. We're going to start with the XLY as an example of that. With the 11 S&P sectors, we are often looking at the XLY for discretionary, XLP for consumer staples. And there are many other ETFs that obviously go a little more granular, looking at gold stocks or semiconductors, sort of different parts of that. The concern that I would have when a lot of people throw around these tickers is just to remember that if you dig in another level deeper, and understand a little bit more about how these ETFs are comprised, I would think of it as part of your normal due diligence. When you're buying any sort of investment vehicle or you're investing in an investment vehicle, you should do those sort of normal due diligence things like the expense ratio or expenses involved, management fees, or how much you're paying that firm or whatever creates it. Totally reasonable that they would deserve some fee for creating and managing the product. But what is that? And do you have better options that might be less expensive for you? The bid-ask spread, right? So how much of a hit are you taking just up for the simple exercise of making a trade in that ETF or exchange traded product, ETP? But with the ETFs in particular that we're going to talk about, the XLY and the XLK, I want you to think about how narrow the focus is. And what I mean is they're very, very top heavy. So for example, on the XLY, which we're looking at here, the consumer discretionary ETF, nice run from the June low up to the 200-day, now pulling back. Now, what you have to remember is when you're looking at the chart of the XLY, you are essentially looking at 3 stocks and then a bunch of other things that have the same weight as those 3. And those 3 are Amazon, Tesla, and Home Depot. So when you are looking at XLY, you're basically looking at a combination of chart 1, Amazon, of chart number 2, Tesla, and then chart number 3, Home Depot. And so when you buy the XLY, you are getting exposure to consumer discretionary, but essentially 3 concentrated names. And then you have a bunch of other things in there, all the other S&P consumer discretionary members, but their weightings are much smaller because they're weighted by market cap. So you have a couple options. Number one, just recognize the fact that you have that overweight and realize that in your portfolio, if you have a big position in XLY, you basically have big positions in Amazon, Home Depot, and Tesla. Or you can look at the equal weighted version, the RCD. So what this does is it looks at the same constituents, but at equal weights, basically one position in each of those stocks, as opposed to weighting it based on the market cap. So when you look at the trends in the RCD, you're getting a better sense of the trends in those stocks as a whole. The same thing when you're looking at the XLK, you're essentially looking at 2 stocks, which are about 45 to 50% of that ETF, Apple and Microsoft, right? So chart number 1 is Apple, chart number 2 is Microsoft, and the 2 of those together make up about half of the weighting you're getting when you look at the XLK. Now, why, if they're so concentrated, do we look at the XLK and the XLY? And the reason is because what I found is for a lot of individual investors, a lot of financial advisors, if you're trying to get exposure into a particular sector, you tend to use one of those ETFs or one of the sector spiders or something similar. You're probably using a cap-weighted ETF to get exposure to those names or exposure to that area of the market. So just like with the XLY and looking at the equal-weighted version, the XLK also has an equal-weighted version called RYT. This is a equal-weighted technology ETF. So again, it sort of takes out the overweight in those two stocks and gives you more of a general feel about the overall environment. So what do we do with that? A couple things to mention to you. Number one, if you use the RRG, which we often do on this channel, and I've talked with Julius de Kempener, who created this visualization for years, about ways to think about this and way to use this visualization to better understand sector rotation. Remember that when you click up to groups, we're basically using the S&P sector ETFs. You also right below that have an equal weighted version. What that is going to do is take the equal weighted ETFs and use the equal weighted S&P benchmark, RSP. And now I'm getting more of a sense of how the stocks that comprise those ETFs or those sectors, how they're doing as a group versus the overall market environment. A lot of times it'll give you a very similar read, and that can be fine. But sometimes when Tesla or Home Depot or Microsoft has a significant move, a lot of times it can skew the difference between the cap-weighted and the equal-weighted ETF. So that can be an interesting way to sort of take your sector understanding and sector dynamics experience to maybe another level of granularity. I also have a chart list, which I'll try to get to here, called, what is it called? Equal weight versus cap-weighted ETFs. And what I can do here is show you with our summary page, each of these ones. So for every one of the 11 S&P sectors, you have an equal-weighted version and a cap-weighted version. So for example, for communication services, EWCO is an equal-weighted communication services ETF. You can do that relative to the XLC. Why would you do these in a relative basis? By looking at the relative performance of the equal-weighted versus the cap-weighted, you can see whether it's the mega cap names in the sector that are causing the performance to do a certain thing, or is it the the smaller companies, right? Is it large versus small? Which one's doing better within each one of those sectors? And by looking at these ratios, if the ratio is going higher, it's the smaller stocks within the ratio, within the sector that are doing better. If the line is going down, that means it's the bigger companies, the mega cap stocks that are doing better. So by looking at the RRG with the equal weighted ETFs, by bit more about what's actually driving the outperformance or the underperformance in a particular sector that you're interested in. That is our segment, ETFs Engaged, trying to drill in a little bit to some dynamics behind the ETFs you may be looking at. We need to wrap today's show and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. The Russell 2000 ETF, ticker IWM. We've talked about small caps off and on, not too much recently, but I wanted to highlight just a really interesting pattern. I had a lot of questions recently about what's next, obviously, from the rally in June, which I certainly have been labeling a bear market rally, but getting above swing highs really changed, I think, the dynamic of what this market really is telling us. Now that we've broken to new swing highs, we've stalled at the 200-day, the S&P did that, the NASDAQ did that, the Russell 2000 has done that as well. We came out of that overbought region and the IWM has pulled right down to 190, which just happens to be the breakout level from June. We were at a critical price point for the IWM. One of two things happens. Either we break above off of that level of support and break above 200. That would be the bull case. And I think if that happens, you will hear me and many others go all in on bullish excitement for these markets. If the IWM breaks down through 190, that tells you most likely this rally has stalled out. We're trying to see further weakness. Then we look down to the 50-day moving average and previous levels of support to see where we might find further retracement to the downside. But 190, a key level for the IWM, and we are there right now. Chart number 2, the real estate sector, XLRE. It was great talking to David Auerbach today from Armada ETF Advisors. Super familiar with the REIT space. And it's always great to just get a little bit of expertise and insights from him onto how that sector of the market works. Because I know for a lot of investors, it's an unfamiliar area. When I'm looking at a chart of the XLE, just like we saw so many extreme movements and pullbacks, real estate really has pulled back from the 200-day moving average, but now testing trendline support, taking the June low, the July low, lining up so far with the lows this week. That's a trend line I would watch to see if real estate can hold that trend line support and bounce higher off of that position of short-term weakness. Finally, the materials sector. We've seen renewed strength in commodities. We talked about the DBC yesterday rotating to the upside. The energy sector has been one of the top performing sectors pretty much every day this week as the XLE has made a new swing high. I wanted to highlight one of the material stocks doing the same. MOS making a new 3-month high today, or threatening a new 3-month high today, up 6%. Overbought right now. And again, breaking above trendline resistance by any sort of measure, now bouncing to the upside. The question is, can it hold previous support on any pullback? 5250 would be a level I would watch for Mosaic. Folks, that's our show for today. I want to thank David Auerbach from Armada ETF Advisors joining us from Texas. All of our previous interviews are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night.